Hey, if you've got a profitable S-corporation, like tons of profits coming in, or your LLC, doesn't really matter. In this video, I'm going to show you how you can take those profits, invest in a short-term rental to reduce down your profits and essentially save a lot of money on taxes. What I'm going to talk about specifically is how to use losses from short-term rental against your S-corporation profits, because short-term rental has really favorable tax rules, tax deduction rules in the IRS tax code. We're also going to talk about how you can take your S-corporation profits via distributions to be able to invest in a short-term rental, and at the same time talk about accelerated depreciation that will help you with your losses and how to do this every year going forward. Ready? Let's get going. Hey, welcome to my whiteboard tax strategy. My name is Boris Musheyev. I'm a CPA and a certified tax strategist. Every Tuesday, I release a tax strategy video here on YouTube for you, the business owner. By watching this video, my goal is for you to start paying less in taxes right away. So go ahead, subscribe to my channel, like it, share it, and even comment below. I appreciate you. Now let's get started. Awesome, welcome back. Now, I know there's a lot of information on the board. I actually prepared show notes for you down in the description below. You can actually download the PDF of a little bit more detailed information about this. Also, before we get started, please make sure to like the video so it helps the YouTube algorithm to push out the video to more business owners. Now, what we're gonna get started with is, first of all, we have to understand what is short-term rental. Think of it as an Airbnb, buying a property, putting it out on a website such as Airbnb or VRBO. Now, your definition of short-term rental is very different from the IRS's definition of a short-term rental. You might think, hey, a short-term rental is something I rent out for 2 months, 3 months, 3 days, 5 days, and so forth. IRS's definition is completely different, because IRS says, hey, for it to be considered a short-term rental, it has to meet 3 rules, like the most common, essential, so to speak, 3 rules, and it has to qualify as a short-term rental. Now, IRS says, first of all, the average stay per tenant has to be 7 days or less. So let's take an example. You've got Joe Smith as your tenant, stays for 2 days. Then you've got Jane Smith staying for 10 days. So 10 plus 2 is 12 days. Average between those is 6 days. So right off the bat, you qualify for the test number 1. So average stay per tenant is 7 days or less. Second thing is that you have to have active participation hours and participate 100 hours in your short-term rental. You know, putting the listing up, cleaning or ordering a cleaning service, whatever that is related to your short-term rental. And it cannot be more than any other person. Let's say, for example, you do spend 100 hours, but you also got a property manager that spends 150 hours. That would disqualify this. Now, meeting this rule is essential for you using this tax strategy so that you can wipe out some of your S-corporation profits. So now that we understand what is a short-term rental, let's move on to a tax strategy in detail, and then we're going to talk about an example, and we'll be back right after this break. Hey, thank you so much for watching my videos so far. I wanted to give you a heads up. I've got this free PDF, 7 tax write-offs that every S-corporation business owner must know. The link to this free PDF is down below in the description. So to make sure to download it, that's it. Now let's get back to the video. All right, perfect. Welcome back. Let's talk about tax strategy. Now, why is short-term rental such a great tax strategy for you? Well, number one, rental real estate, any rental real estate, one of the main benefits of any rental real estate is that it can produce losses due to depreciation. That is called a paper loss. You may be cash flow positive, but that's going to be a paper loss. That loss can be deducted against your business profits. If you've got a long-term rental, most likely that loss is a passive loss. You will not be able to take a deduction on that. But short-term rentals, they play a different rule. They're considered under a different rule in the IRS tax code. That means any losses generated by a short-term rental can be deducted against your other ordinary income, and in your case, the business owner, against your S-corporation profits. Remember, you have to qualify for these 3 rules, and in order for you to really know these 3 rules, ladies and gentlemen, you've got to be working with a tax advisor and stop working with a tax preparer. This is not something that you can plan for after the year is over. You really have to work with a tax advisor to plan this out, to make sure you meet this rule plan for your profits and be able to deduct your short-term rentals against S-corporation profits. Now that we've determined the fact that you can actually take the losses from the short-term rentals and invest into real estate, write it off against your S-corporation profits, let's talk about how can you invest. A lot of business owners, S-corporation owners especially, they've accumulated profits in the business. There's money in the bank account and they're already taking out salary, they're already taking out distribution, and like, hey, how do I take out the rest of the money? Can I really invest it in real estate? And how do I do that? One example, what they do, which is for the most part is incorrect, they take the money out as a loan to invest in real estate. That could be a short-term rental, a commercial property, or residential property. It doesn't matter. Now, when the loan is taken out, it's very easily recorded by the tax preparer and your bookkeeper as, hey, loan to, and so forth. But you never have an intention, so to speak, to pay the loan back, right? Usually a business owner takes his own money from the S-corporation to invest into something. He has no intention of paying it back. It's his own money. But now the loan is recorded on the books, which is incorrect, which is not really in compliance with the IRS, because when you take out a loan, you have to have a loan agreement, you have to pay back that loan, you've got to pay back the interest. And what I teach a lot of business owners, I'm like, look, you've got enough profits in the business to be able to take out a distribution. Now, in some cases, those distributions could potentially be drawn against the equity, meaning to say how much equity you as an S-corporation could have in the business. I actually have a very detailed video on that. I also put it in the show notes below, not to draw against your S-corporation profits. But in most cases, as a tax advisor, we assess the equity, shareholders' equity in the business. Do you have enough equity to take out the profits instead of as a loan and invest in your short-term rental or a long-term rental? So that is the tax strategy. You've got to work with your tax advisor to be able to come up with that strategy to be able to do that. Once you've determined that, hey, I can take my losses from the short-term rental by qualifying with these 3 rules, now I can invest with my S-corporation profits. What you're going to do next, once you invest in short-term rental, is to make sure you take an accelerated depreciation. An accelerated depreciation could be taken by using what's called a cost segregation. The cost segregation is a whole different topic. I've also have a very detailed video on that. Should be in the show notes below for you, so definitely watch that. But what cost segregation allows you to do is take a property and accelerate its depreciation in the first year. We're going to talk about it in an example right here, which in most cases for your short-term rental, that could produce a really nice big loss. And now that we've talked about that you can actually qualify under IRS's definition of the short-term rental, that loss can be taken against your S-corporation profits. And that accelerated depreciation can help you every year. Now, when you do cost segregation and take the accelerated depreciation, you can only use it in your first year because all of that accelerated depreciation, so to speak, is taken in the first year. Next year, you will not have that same benefit from that same property. So what do you do as a tax strategy? Once you know that you have enough profits in your business, you've got distributions to take out. And again, you've got to do this with your tax advisor, not a tax preparer, not when you do it at the end of the year, okay? When you do that, repeat that strategy every year, and that's going to multiply your savings. We're going to talk about this example, exactly how this works, everything that I talked about. Also, I've put all of these notes in the show notes below in a PDF. Just click on that and download the Google Drive, and we'll be right back after this break. Hey, thank you so much for watching my YouTube video. Just a quick commercial break. If you like what you see, please like the video. As a matter of fact, share it on your YouTube so that you can help other business owners to save money on taxes. I would also appreciate it very much if you subscribe to my video. If you like, share, or subscribe, it really helps me with YouTube algorithm, where YouTube will really push this video to other business owners and they can learn how to save money on taxes using simple tax strategies that I teach with my whiteboard strategy. Thank you so much, and let's get back to the video. Awesome. Let's get back to this. Now let's talk about an example, okay? So I've got Sam right here, okay? He's an S-corporation owner, pretty profitable S-corporation. After salary, his profits is $750,000. It's like, Boris, what can I do with my profits? I want to start investing in real estate. What is the best way for me to do so? Now, I have determined that in this case, for him to invest in a long-term rentals is not a good idea because he's going to have losses that are not tax deductible. I've put together another video for you to learn about that in the show notes below, so definitely check that out. So I said, hey, short-term rental could be a great idea. If you find a property that is worth $500,000, right, $500,000, and you put let's say $100,000 down, guess what IRS will allow you to do? IRS will allow you to take a tax deduction, not on $100,000, but on a $500,000. Now, this is not to say that you can write off the entire $500,000. There are depreciation rules that we're going to talk about. So we've then determined that the net value of the building, net of land, right, after deducting the land, because land you cannot depreciate, is $425,000. Doing a cost segregation study, which allows us to do the accelerated depreciation, Sam gets $106,000 in depreciation deduction, give or take. This is approximate estimate, okay? $106,000 in his first year. Because Sam qualifies under the IRS definition of the short-term rental, and he's done accelerated depreciation, was able to invest his profits into it, he's got a $106,000 deduction in its first year. The $106,000 will be deducted against his S-corporation net profit on his personal tax return, essentially reducing down his profits to $650,000. If he is in a 30% bracket, if you are in a 30% bracket, you, the business owner, in this similar situation, 30% on $106,000 is about $30,000 in tax deductions, in tax savings. $100,000 is a deduction, $30,000 in tax savings. Now, if you do this 3 years in a row, not only do you have a cash producing short-term rentals, but at the same time, you're generating yourself a really nice deductions and tax savings of about $30,000 every year. Now, let's talk a little bit about the IRS compliance. When you have a short-term rental, it may be considered as a trade or business, depending how you operate your short-term rental. So definitely speak with your tax advisor. Now, is there a drawback to that? There may be a drawback to that. Now, all the profits from your short-term rental may be subject to self-employment tax once you start generating profits in year 2, 3, 4, or 5, okay? And then your tax advisor, based on the situation that you have, can decide whether these profits from your short-term rental are subject to self-employment taxes. Now, we as tax advisors tell our clients, hey, if you do this, this, and that in your short-term rental, you may qualify that you do not have to pay the self-employment tax and instead would have to file a Schedule E for this short-term rental. There's a lot of planning that goes into it, but I promise you, once you've got a proper plan to be able to qualify for short-term rental under the IRS definition, be able to invest your profits if you have profits in the business or distributions, or maybe you have some money in the savings account, okay? Then go ahead and invest in the short-term rental, accelerate depreciation, get accelerated depreciation, produce really nice tax deduction in your first year and tax savings. If you're working with a tax preparer or just a bookkeeper or somebody who does your taxes once a year only, I guarantee you, these are not the things that you talk about with your tax preparer. If you want to start saving money on taxes, you've got to start working with a tax advisor. Show notes, again, for all of this is below. There's also more resources for you below, down in the description. Thank you so much. Until the next time.